Every decision we make is influenced by how we think, how we feel, how the people around us feel, and even how we were raised. Whether it's the fear that keeps us from investing at all, the excitement that makes us buy during the hype, or the regret from selling a stock at the wrong time, psychology is at the forefront of all of it. You can have the perfect financial plan, but when your emotions take over, it all falls apart. That's why understanding our own behavior and biases are necessary to understand how we can change our behavior.
If you're curious about my background, I have a social science degree in sociology.
Expert investor Peter Lynch says that even school-age children can be great investors. He even goes so far as to say that they can beat the suits on Wall Street in his book, Beating the Street. And just a PSA, if you have Spotify Premium, his books are included at no additional charge, and One Up on Wall Street is a great place to start. Your biggest threat as an investor isn't the stock market. It's your own brain. When you see how it works, you can start to work with it instead of against it. A big emotion that controls us is fear. Fear kicks in when the markets dip. Suddenly, even though we know that it's normal for prices to drop, we panic. We feel like we're gonna lose everything, so we sell at the worst possible time just so that we can feel safe. In contrast, the smartest investors are actually excited when the market goes down, because that means that they can buy more of their favorite companies at a discounted price. If you're gonna take anything from this video, it should be that you should not sell a stock if the fundamentals of a company are still good. The only thing that you should be doing in a dip is buying great companies for a great price. The next emotion we deal with is greed. When the stock market is going up, we want in fast. We feel like if I don't get in now, I'm gonna miss out. Or we even think the only way the stock can go is up. That FOMO can lead us to buy high instead of waiting to see if a product is actually liked over time, or wait and buy when the stock inevitably dips. Because one thing that we know for sure about the stock market is that it will go up and it will go down. Let's not forget about the feeling of overconfidence. Once we've made a few good deals, we think this is a sure thing, or I have it in the bag. But that's when we stop researching. We miss the red flags in the market or with a company, and we take big risks. You shouldn't just research a company once. It's an ongoing process, ensuring that you still believe in where the company is going and their fundamentals are still good. My point here is that emotions aren't bad. We actually need them. They help us make good decisions. They keep us safe, but they're loud. So it's important to understand your emotions so you can regulate them so they don't end up running the show, and instead you can use them to help gauge your own personal risk tolerance. Don't just take my advice. Let's look at one of the greatest investors of all time, Warren Buffett. In 2008, during the financial crisis, when the stock market was absolutely crashing, when most people were trying to sell out and they were panicking, what was Buffett doing? He was buying. Why? Because he was investing with logic, not with fear. He took $5 billion and purchased investments in Goldman Sachs, and he made billions of dollars in returns. This is how you invest, not with fear, not following the hype, by being consistent. Most people let fear and FOMO guide them, but the best investors, like Buffett, they are being patient and they are being calm, waiting for the right moment. How about a story of people following hype? During the 2020 tech boom, Cathie Woods and her ARK Innovations ETF was super popular. People wanted to buy in and they saw all these great returns and they felt like if I don't get in now, I am going to miss out. But the reality is many of these investors were latecomers. They joined after they saw that people were making money and they bought right at the peak. ARK had gained 150% on its position and it dropped, as the stock market does. And these people that were basing off of hype, they lost. So how can you keep yourself from making these rash decisions? Here's some practical ways that you can put this into practice. One of the first ways is that you need to have a plan and stick to it. Decide when you're going to buy and sell and under what conditions. Don't make rash decisions in the heat of the moment. Stick to that plan. Next is zoom out. When the market takes a dip, take materials and charts like this one and realize that in the long term, the stock market has always trended upwards. Set yourself no-look periods. When you're constantly and daily monitoring your investments, that is when you feel the anxiety rise in you and you want to make those decisions. So just set a time and say, I'm not going to check my portfolio for a month or 2 months. And this is how you can be more consistent. You next need to know your own triggers. Do you tend to buy when something is super popular or when there's a lot of hype and headlines around it? The first step to stopping these behaviors is knowing that you're doing them at all. Recognize your patterns and stick to your plan. You can study the greats. Study calm, rational thinkers like Warren Buffett and Peter Lynch. You can read about what they did when the market went down and try to do the same. Lastly, invest like you're planting trees. If you plant a tree and dig it up every time the wind blows to try to protect its little branches, you're actually hurting the growth of the tree. Treat your investments the same way. Give them time to grow. One super way to get started is to invest in fields that you already know about. Use your knowledge and leverage it to make smart decisions. I used to spend without thinking. Now I invest without doubting. This is not the end of the story. Your brain, your friends, and the way that you were raised might be the reason you're not rich yet. Let's fix that.